Hello everybody, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns, or no, I forgot, it's as the virus is churning and burning through the housing market, causing us a lot of problems for the near future. All right, today is Friday, May the 1st. What is so important about today? It's May the 1st, which means a new month, which means a lot of things are due today, like rent and mortgage payments. We'll see if this continues. I think we all know what's going to happen over the course of the next month. I'm Randy Patrick, your host today. Putting the realism back in real estate. That's the new tagline, or the tagline I'm using from now on. And we got lots to talk about. So basically, the big news of the week so far is the unemployment claim. So we now know that as of yesterday, which the numbers are released, that more than 3.8 million laid off workers applied for unemployment benefits last week. And that's roughly 30.3 million people have now filed jobless claims, which is not very good, obviously. With more employers cutting payrolls to save money, economists have forecast that the unemployment rate for April could be as high as 20%. So coronavirus kills 30 million U.S. jobs. Now, here's the thing, though. 30 million on record so far, but some outside reviews suggest that the number of job losses is likely even higher than captured in the weekly unemployment claims. A poll by two academic economists found that the U.S. economy may have lost about 34 million jobs since March, when the coronavirus began the shutdown. And a survey by the Economic Policy Institute, it found that up to 12 million more people have lost jobs but haven't filed a claim for the benefits, either because they couldn't get through their state's overwhelmed system or they didn't try. Perhaps it was too difficult. So, there's a lot of stuff happening here. So we have, claims that we know exist, about a little over 30 million. We've got all these estimates that there could be up to 12 million more people that haven't filed for various reasons. That's from one survey. A second survey found that they believe that 50 million Americans have lost their jobs in the past couple of weeks, that basically 30 million is an underestimate, and that's some of the reasons why I stated that. They just haven't had a chance to. Their systems are overwhelmed. They can't get through. They get discouraged. There's lots of reasons why people may not have filed a claim, but again, I think the numbers are underestimated, and we're going to see how this plays out as time goes on. Not very good for the jobless scene. Now, pending home sales tanked nearly 21% in March, but realtors claim that prices will hold up. So, don't you worry, Mr. and Mrs. Seller. We're going to get you top dollar for that house, all right? Signed contracts to buy existing homes, referred to as pending home sales. Yes, they are pending home sales because there are contracts that will close in the next couple of months, so they're pending. Fell 20.8%, so almost 21% compared with February, and were 16.3% lower annually, according to NAR, which is the National Association of Realtors. Now, the housing market is temporarily grappling with the coronavirus-induced shutdown, which pulled down new listings and new contracts, said Lawrence Yun, NAR's chief economist. So not a good thing going on here. If we take a look at regionally, pending sales fell about 14.5% in the Northeast for the month. In the Midwest, sales decreased 22% on a monthly basis. In the South, sales dropped 19.5%. And in the West, they fell 26.8%. So that's pretty big numbers when you take a look at what's going on in the real estate contractual world. And again, pending home sales. So I signed a contract today, and then at closing expectation could be 30 days, 45 days, 60 days in the future when that will actually be an existing home sale. So these are future things. Now, I can tell you that these pending numbers are what's under contract now. Those numbers could change. And what I mean by that is they could fall out of pending. And so really, that could actually even be worse if you think about it. So you could be pending, but maybe as time goes on, a couple things happen. What if you lose your job, or you have your hours cut back, or something else financial hits, where the lender suddenly goes, okay, we now have pulled your credit again, or we see you were supposed to give us all this information, and we see that something has changed, so we're not going to lend you the money to buy the home. So some of these pending contracts could very easily fall out of contract and go back to to nothing in the course of the time it takes from pending to close sale. So there's still a risk factor right now. And if I'm a seller, I would be really leery about who's buying my property, what their buying credentials are, and really finding out credit score, proof of funds, all those things, like how legitimate is this deal, and what is the I guess you could say, what's the chance that this will close, what's the chance that this could fall out. So that could really cause problems for a lot of people, especially domino effect, i.e., you're going to move from your house when you're to a new house when your house sells, but this person, fell out of contract at the last minute because of finance or other issues you can't control. Big effects down the road for a lot of people. So very difficult time with respect to people moving out of their places. Now, talking about where we are end of the month here, mortgage forbearance balloons, home sales plunge. So in addition to logistical difficulties selling a home in the era of social distancing, there is the explosion of a historic unemployment crisis, which we just spoke about. So by the end of April, there will be 4.2 million mortgages in forbearance, or 7.6% of all mortgages, the American Enterprise Institute estimated in a note based on the forbearance data released through April 19th, that was released by the Mortgage Bankers Association. So the estimate is that we're going to have over 4 million people that have applied for forbearance or are doing forbearance in the month of April. All right. So that's why I say when May 1st starts. So what's going on with May 1st? Well, you've got people who could say, I was employed in April, but I've lost my, in March and I could pay April, but now, April's gone through. Maybe I lost my job or had my hours cut, so I don't have the cash, or I'm going to conserve my cash and elect to do the forbearance deal with respect to May's payments. So there's a lot of things that can happen. This is a moving target at best. So that's not, that could cause more problems. Again, what we're not really talking about, as I mentioned earlier in the previous videos, is the fact that the 9 million, landlords that have all rental property out there, and with respect to if their tenants are, having job loss issues, and part of these people who are, hitting, affected by the pandemic and filing unemployment claims, and they're not paying rent, which means those landlords may not be paying mortgages associated with the property if they can't afford it or have the cash flow or have the reserves. So not a good scene. So obviously we know the market, March deals plunged. So again, our expectations that we're going to see, that was their estimate. The AEI's estimate for April was 4.2 million. Now we're going to see another wave of people coming through here. So I would expect that we could see at least 2 to 4 million people again not paying their mortgages or going into forbearance. So and again, the difficulty is that what we're capturing here, is forbearance. So we know that the 4.2 million people are in forbearance. What we're not seeing is the fact that, okay, you're in forbearance, so you're now a new pay count in this bucket over here. What we're not talking about or tracking is, you didn't apply for forbearance, or you can't do forbearance for whatever reason, and guess what? But you've not paid your mortgage, so you're delinquent now. You see, so we're not capturing this bucket over here, so we don't even know about that statistic. So if 4.2 million people have done the forbearance thing, there's going to be a portion of people that couldn't or haven't, and they're in the delinquency bucket over here. So the net amount is probably more than what we're seeing right now or what's obvious to us. So please keep that in mind. Now, mortgage applications to purchase a home in the U.S. during the week ending April 24th ticked up a little bit from the dismal levels of the prior 3 weeks. But we're still down 20% from a year ago, and we're down 34% from the peak in January, so the Mortgage Bankers Association. So, this is the spin, and we all know that anybody can spin the news to their own benefit, etc., even myself, apparently, from what people say. But the point that what I'm trying to make is that, when we've drop, when there's a slight uptick, that's not a recovery, but people try to spin it going, things are great, so maybe things are looking better. Well, 1 week's, what they always call the dead cat bounce or whatever, like 1 week's a slight uptick is not a recovery, all right? So please keep that in mind. It basically is, basically this was the 6th week in a row of year-over-year plunges. The first 4 weeks of April, the index has plunged 31% compared to the same period last year. That's the mortgage application index. So basically, and that's, we're talking, actually this is just purchase applications, not necessarily refis. Now, the refis are still working through. It says, I don't have any information yet on the refi stuff, but here's something interesting, though, that we're not talking about. So when we're talking about sales and purchases and stuff like that, what we don't include are buyers who don't need a mortgage from a lender in the U.S., including some formerly prolific buyers that have now pulled back, and their disappearance is not reflected in the mortgage data. So what we're seeing now is non-resident foreign investors who bring cash or finance their purchase overseas. They have largely been locked down due to travel restrictions. So a lot of people who would normally come over here and go, hey, I'm going to buy some U.S. real estate for whether it's apartment complexes or single homes or duplexes, whatever. Guess what? They're not bringing their money because they can't travel. So we're going to see home sales are going to suffer from that. Large U.S. buy-to-rent investors that fund purchases at the institutional level, they're now struggling with turmoil in the lending markets and uncertain demand for rental housing. Well, I find that a little bit of a unique statement because I certainly believe that from what I'm seeing, maybe not from the institutional investors, but from a couple tiers down, I'm seeing a huge demand and interest of rental properties. And the sort of overlying concept is, if we buy something now, we can try to get lower price points and ask for discount. That's the sort of general mindset we got going on right now. And also, don't forget the iBuyers. That's a big number here too. The iBuyers, people that the groups that buy and flip homes, they're doing it at steep losses, right? I mean, you saw Zillow's numbers earlier this year with respect to they were losing money on their transactions just to gain market share. So basically, Zillow, Redfin, Opendoor, iBuyer, and OfferPad, they all have shut down their home purchases. And demand for them has collapsed to zero, and now they're trying to sell the homes they got stuck with. So yeah, that's the situation you're in, right? When you're buying, at an appreciating market, you're discounting, you're improving, you're selling, you want to make your margin. It's got to be going up. Well, now it's probably not going to be going up. It's plateauing, and it's probably going to be going down this way now. That's number one, and lack of buyers. So your buyers that would normally jump in, there's number one, less of them. Two, they're not looking at your homes, and three, they may not be financed like they used to be, and that's the number one thing. So, and by the way, when people contact me and say, I want to buy a home, blah, 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 I want to do stuff, I'm like, great, I engage them. The first thing I say is that, are you pre-approved? They say, yes. When did you get your pre-approval? Oh, I got it back in the beginning of April. Okay, well, guess what? You need to talk to your mortgage person again and make sure that whatever you were pre-approved under, that number one, you're still pre-approved, and two, your loan terms or conditions or programs haven't changed, which means maybe you're pre-approved, but your 3.5% down payment is now 20%. Okay, who knows what's going to go on? So if you're looking for a home, make sure you have a recent pre-approval. That way you won't be shocked. And it works both ways. You know what you can afford and what you can buy. Then when you go in to make an offer, you can go in strong saying, hey, it's a recent pre-approval. I've got the down payment. I can close on this, yada, yada. And now you're a stronger buyer as opposed to somebody who's got an earlier pre-approval, the low down payment. We're not too sure whether they can still come up with that money or the lender's actually going to lend to them based on some of the guideline changes, credit score, raises, stuff like that. So please keep that in mind. All right. So anyway, the demand and drops from the foreign buyers, from the iBuyers, from the investor institutional buyers. I mean, we're not going to see it in the mortgage data, but they say that the drop in demand will show up later in the home sale data a few months down the road, which I do agree. All right, investor update: COVID-19's near-term rental impact. So clearly, we know that a lot of the people who are experiencing, like the first wave of people in hospitality, industries and things like that, they're more in the rental marketplace, and that's going to affect and has affected, the trickle down of apartment complexes or, mom and pop, single family landlords that actually rent to these people. So really there was a little survey came out, said nearly 16.5 million renter households have at least one worker in an industry likely to be immediately affected by efforts to flatten the curve in the COVID-19 pandemic, according to research from Turner Center of Housing Innovation at UC Berkeley. So what this really means is that among, again, it's just a lot of people are, I guess you could say, in a situation where they probably have lost a job or have significantly lost income. Among likely impacted renter households, more than 7.1 million were already experiencing housing cost burdens and are likely to be especially vulnerable. So roughly 43% of likely impacted renters households were already struggling with rental cost burdens before the virus took hold. That share stretches even higher now. So you got different states that have a lot of exposure, but 30% of the nation's likely impacted renter households are in California, about 2.3 million, Texas, 1.4 million households, New York, 1.1 million, and Florida, just shy of 1 million. So you got basically, we're talking 1, 2, 3, 5, about 5.5 million, we'll call them, renter impacted households that are going to be precarious for landlords and stuff like that. So as I said, everything's a trickle-down domino effect, right? And this is going to cause problems for a lot of people if you can't pay your rent. And listen, I'm not even talking about this today, but because I don't really think it makes sense yet. But there's all these rental strike, people banding together saying we're renters and we're going to go on strike and not pay rent whether we have it or not because they're looking for some bailout in that capacity. And I'm not going to comment on that because it's more of a financial issue. Bail out personally, don't bail out renters in general. People who have the money to pay should still pay. I mean, as simple as that. I mean, landlord owns a home, and not all landlords are bad, right? They provide a service in the industry. So, again, they're going to get, and I mean landlords, I'm talking about individual mom and pop landlords, not the corporations, not the multifamily units, whatever. So that's the group I think that'll really be hurt a lot because they've bought homes, they've risked, they've mortgaged, etc. They've put their savings out. They're really exposed in this situation. All right. I talked about this a couple weeks ago or a couple of videos ago, and I've seen a few, we'll call it headlines and some other videos out there. It's about Airbnb, and now people are picking up on the trend going, okay, well, will an Airbnb implosion trigger a housing bust? Well, we always, there's always something that starts the process. So what do we have today? We have a situation where, we've got, the rental market typically is the first to go. It's the investors in rental markets where it's not your home, not living in your home. You don't have the same protections that are available to you legally and maybe with your mortgage company on forbearance and things like that. So that segment is definitely more exposed to, I guess you say the cracking parts of real estate as it goes. So as I say here, will the Airbnb implosion trigger a housing bust? Why do we talk about Airbnb? Well, Airbnb is a great concept, and a lot of people, I've used it a lot. A lot of people use Airbnb as to live, to travel, to work, etc. So it's to earn income. So it's a very, very open-ended, broad sort of spectrum of how Airbnb works in our life and society here. Well, the issue is that the number of Airbnb cancellations and just the steep decrease in reservations is it's gone down big time in the U.S. Okay, we're looking at from around 550,000 bookings down to probably around just over 100,000 bookings in the U.S. So so it's lost 4/5 of the marketplace right here. So the real issue is that how are you set up as an Airbnb host, right? So if you're one person that owns or if you own a home and you're renting your home out, that could be exposure. If you own a home, you live there, but you're renting a room out, that may be a lack of income for you. That might hurt you a little bit. But the real exposure sort of moves into what I call the superhost realm. All right. So the superhosts are people who own lots of properties. All right. And this is where it really is interesting. There's a website out there, and I've been looking at this the past couple of days. So we have Airbnb, which is the platform to short-term rentals. Well, there's a website called AirDNA, which really is we'll call it a research and data center that if you're looking to do maybe Airbnb rentals, you could go to AirDNA and you could purchase reports on zip codes or state or city locations, so you can determine, hey, where's the best spot for my, to get an Airbnb. It gives you all the stats. It helps you determine marketability, investment opportunity, the whole bit. So basically, they said that AirDNA has determined that a third of Airbnb hosts in the U.S. have one property. So a third of all the hosts in the U.S. own one property. Another third have 2 to 24 properties. It's a lot of properties. And get ready for this: the other third have more than 24. So think about that. If you own more than one property, you're probably financially exposed. You probably need that income to pay for the mortgage or some sort of financing, whatever. I mean, I could read on here, and there's lots of articles now about the people who get mortgages and they spend $100,000 furnishing and decking the places out, and they're making all this great money. What a great concept! Bang. Travel and tourism is dead. Airbnb bookings are down roughly 80%. I mean, what's going to happen here? So, will this be the trigger? Well, I guess you could say we already kind of have the trigger. The trigger is the pandemic, the coronavirus, but usually there's the first, what's the first foreclosure trigger or mass sale or discount sale trigger? This could very well be it. And, you've got people who are going to go, well, there's two things. Either these hosts could either own the properties, so they've owned it, and if they own them outright, they've bought them, and they've had to have some sort of financing to carry this. So that's number one. Or two, what they've done, because this is a concept, is if you have a house that you're looking to rent, there are hosts that rent your house, for a flat monthly fee, but then they've converted their rental opportunity to an Airbnb. So they're paying, just for example, $1,000, in rent to you, but they're making $5 or $6 grand a month based on the short-term rental rates. So you see, those people now are going to go, well, now my rents, so they may not own the property, have the mortgage, but they're supposed to pay the owner a monthly rent. And they may go, I'm not paying that because guess what? I'm not having my income, so it's just a rental agreement. You can't even evict me because you're like the owner, whoever's leasing it doesn't even live there, right? So it's kind of like, come on after me. I lease it from you. I don't live there. Sorry, I can't handle it this month. So that's where I see a lot of this damage happening. And I really think that concept of people who don't, and I guess it's what I learned in the last housing crisis, and even nowadays too. If there's no skin in the game, then people tend to walk away or get emotionally divested from the properties and have no problem walking away and taking their losses or their lumps. So in this case, you've gone on, you've got a lease with a landlord, you're Airbnb out of that lease, your bookings are down. What do you care? He can't evict you because you don't live there. He can evict you to get out of the lease. That's great, but so what? You know what I mean? So what's that going to prove? You're not there. He can just go grab the property right now if he wants, he or she. Okay? So very interesting. This could be part of the triggers. It won't be the trigger, but it'll be a number of things at play hitting at various times here. But again, think about this too. 1/3 have 2 to 24 properties and 1/3 have more than 24. That's of the U.S. Airbnb industry here, in the U.S. Unreal. All right, 5 ways the coronavirus could affect home prices. Well, this little article came out from, I think, National Mortgage News here, and just some comments here, but they're not bad here. So they believe that, big cities have lost some of their appeal, which we're already seeing that. We've seen some of the Zillow searches and Redfin searches have said they've seen an uptick in people who are looking at properties out of the city core. We've talked about density, again, we're going to have people who are in apartment complexes who are not going to renew when their lease comes out. Okay, they're going to go elsewhere, maybe to smaller complexes or to single family homes. Number 1, 2, people who are going, okay, I don't want to be in a very dense populated situation because of the pandemic and what I've learned and how we operate now. So I want to get out of there, go someplace else, farther away from the city. And also the fact that, what have we learned and what are we doing now? We're doing a lot more remote, a lot more video conferencing, teleconferencing, teleworking, whatever. There's a lot of people now and corporations are going, maybe we don't have to have everybody at work. Maybe we don't have to have a huge office. Maybe, I don't have to have a brick and mortar establishment to service my clients. I'm doing everything remotely and virtually now, and I'll just go on the road, you see? So it's going to change the way we think. So that's losing their appeal. Millennials' interest in home buying may wane. They basically saying that, and again, for about the past 4 to 5 years, I've always been reading that the millennial generation was going to be the savior generation for the U.S. housing industry. All right. Well, that really hasn't been the case, and even maybe it's going to go opposite now because millennials have been part of a demographic wave that supports housing, but there are questions about whether they will support it going forward. Like, do they still have jobs, or do they even want to be in one place if they have to move around to find jobs? Renting gives them flexibility. Homeownership does not. Right. When you own a home, you're kind of stuck, and you got to sell, and then all the ramifications and cost to go along with that. So if you're renting, you're a lot more fluid and can move to where the jobs are or relocate if your finances change. That's a good point. Pension funds challenges may have ramifications in certain states. So yes, there's a lot of pension funds out there. When I think of pension funds, I think of Illinois first because it's very well documented the situation they're in here. So basically, what do we see here? So if we see people losing their homes and we see real estate values dropping and people everything is devaluing or the revenue's not coming in to support that. So a decline in state revenues and decline in the assets backing the pension plans could lead the states to turn to other sources of revenue, and that could in turn to property taxes. So they may turn to things like transfer taxes to make up a shortfall in the budget or to cut services. That's negative for home prices. If you do things like start defunding schools, people might move. So we're going to see some locations, some states will probably have a deficit with respect to their funding, and they're going to have to get it someplace. And then that'll, again, have its own effect on home ownership, people buying and selling, moving out, or whatever. There you go. Some are only preparing for one downturn, but there could be 2. So where we are right now is that, as of a couple days ago, we have states that are, opening, have said we're going to reopen some businesses or open parks or beaches or whatever, albeit limited, applications and a limited controlled way, but still we're starting to see things open up. a lot of people in the medical field are predicting the fact that when we do this, we're going, we were flattening the curve, but this is still too soon. So we're going to see a second wave of the virus, and that's going to put us back even more. So again, the concept here, and again, whether I still think the damage has been done anyway, and this could just further damage things. So if we don't get a second wave, eventually housing improves again. So these guys, on the other hand, if we get a second wave here and globally, the economy might collapse even further. It may be a small probability, but it could have a large impact if it happens. So we'll see. Again, I still think the damage is going to go on for a few months, regardless of whether we have a second wave or not. And also, tighter loan underwriting could feed into a downward pressure on prices. So with impacts from the coronavirus hurting employment and making it more difficult to sell certain types of loans to secondary market investors, mortgage companies may tighten their underwriting standards. So if you start requiring things that people don't have, you're going to remove some of the buyer's support for the market, and it's going to undermine home prices, said the national mortgage guys. So, but that's not a bad thing, right? I think we're all at the position and at the sort of opinion that home prices are too expensive, and that we need something to bring prices back down to earth. And when I mean back down to earth, I mean, affordability. And let's take a look. Let's look at this. We've been up for quite some time now. Every month, up until the last case Shiller, we're still slightly increasing our year over year compared to the last housing boom back in 2006. So it's people just can't afford it. But sellers want to cash out, and they're mesmerized by getting that top dollar and cashing that equity out. So it's going to be like a tug of war here. But eventually, sellers will have to reduce pricing because buyers are going to go either I can't do it or I won't do it, and that's what's coming. I certainly believe that. So but they're talking about this as it's a negative thing. Like for me, having a small amount of buyers buy higher priced property. What does that do? Okay, that doesn't really help the market. Having more buyers buy cheaper property means more mortgages originated. But I think the concept here, again, this was an article produced by the National Mortgage Association or something like that, Banker Association. And if you think about it going, they want the values to go up. Why? Because the higher the values go, that's more refis they can pull out with people. So, and then people are stuck, you see. So it all depends on your perspective of where things are at. So very interesting. One thing that we haven't really talked about too much here, because I try to keep this into the residential real estate world, but I do follow the commercial side here. And what's happened over the past little while? Well, malls have shut down, health clubs have shut down, restaurants have shut down, bars have shut down, various stores have shut down. We're seeing a lot of shutdowns in the commercial real estate space. Well, there has to be a catch up to that. So basically, there'll be an unprecedented surge in new delinquencies heralds a commercial real estate disaster. So even though we're talking about a housing crash and where things are going to go on the residential side, let me tell you, it's no fun and games and bed of roses on this side of the market either. So according to the latest remittance data compiled by Morgan Stanley, a record 66 loans totaling $1 billion came newly delinquent in April, which is the greatest month-over-month change. In total, 324 loans with a total balance of $4.8 billion are currently delinquent, which is also an all-time high. So this can be like stores and malls. This could be anything out there. So we're going to see a lot of this happening as we go forward. The conclusion, I'm not going to get into all the sectors here, but in conclusion it says the retail sector is a disaster. Hotels are just as bad. Remember that retail is malls, shopping strip centers, stores and streets, whatever. That's number one. And then you've got the hospitality side, which is restaurants, bars, all that type of stuff. Hotels. Well, guess what? If people are not booking Airbnbs, they're certainly not booking hotels, right? Travel is down completely. So think about all the hotels in every city you live. And again, I just use because it's 90 minutes away to the east of me, but I think of Orlando, and I think about driving to Orlando. It must be a ghost town, just on the west side where Disneyland is. All the hotels, driving on International Drive in Orlando. All that is basically hotels, restaurants, attractions, shopping areas, stuff to do. That's all based on tourism, people coming to stay there for a couple of weeks, a couple of days, whatever. No one's going to be there right now. So that's probably, it's a ghost town. That we're going to see major changes with that. And also what we still haven't talked about is, the multifamily sector. So multifamily apartments out there as well too. they are close behind. They're going to see same thing. Like I talk about the rentals and the non-payments for mom and pod landlords. Well, what about the apartment complexes, the density of the apartment complexes, all right? A lot of people aren't paying there, and the concept or the thought process is a lot of people may be moving out when leases expire because they don't want to stay in the densely populated areas, which is a multifamily complex, et cetera. So we're going to see it kind of on both ends. Clearly, this will happen quicker because going delinquent and going to default and delinquency on the commercial side is usually a couple months worth of non-payment, not X number of months, et cetera, like a residential would be. So it certainly takes longer for the residential market to crash and unfold than it does the commercial side here. So that's it for today. So again, lots going on. We're going to see maybe next week what May 1st brings. That'll be interesting. So we'll be monitoring that. If those of you would like more information on what I offer as far as training to really get into this business right now, please reach out to me with your email and send me your number. I'll text you and we'll get involved. I'm catching up. I'm getting through it. So people I haven't talked to yet, I'm getting there. Okay, this weekend, hopefully I'll be able to catch up on everything. I'm also going to have another Facebook Live tomorrow. I typically do it around 4 p.m. on Saturday for about an hour and a half. So I'll talk, have a few topics I'll get into, and I'll take some Q&A, which I found has been effective. So far, had some pretty good response to that. So again, go to Housing Bubble 2.0 on Facebook if you want to jump in on that. The reason why I do that is it's just an easier medium for me to do that. I am working on improving the channel and getting more software involved, etc., to do live streams eventually on and more training on this medium. But for now, we're sort of trialing it and testing it on the Facebook platform. So again, lots on the go. So give me a shout. Thanks for the views, comments, and likes. Please reach out to me for any information on housing, and we'll look forward to speaking with you early next week. Thanks.